In this introductory journey to inventory costing, we begin with essential fundamentals. Today's lesson opens with a clear focus on the cost flow, cost inclusion, and financial reporting impact. Before we tackle the central question of cost accounting, which costs belong in inventory, we need a quick review of a concept you learned in financial accounting. How costs flow out of inventory when units are sold. The equation, beginning inventory plus purchases minus cost of goods sold equals ending inventory, is central to our discussion. This equation governs every inventory system. It says that the total cost of goods available for sale must be split between two destinations. 1. Cost of goods sold on the income statement, and 2. Ending inventory on the balance sheet. The three cost flow assumptions determine how that split occurs. Cost flow assumptions answer which unit's cost goes to COGS. But for manufacturers, a more fundamental question comes first. Which categories of cost belong in inventory at all? That is the subject of absorption, variable, and throughput costing. Let's examine the three cost flow methods in detail. Each method, FIFO, LIFO, and weighted average, follows a distinct approach determining cost of goods sold and ending inventory. FIFO, first in, first out. The oldest costs in inventory are assigned to COGS first. Ending inventory reflects the most recent purchase prices. In a period of rising prices, FIFO produces the lowest COGS, the highest net income, and the highest ending inventory value. Because ending inventory is valued at recent prices, the balance sheet closely reflects current replacement cost. LIFO, last in, first out. The newest costs are assigned to COGS first. Ending inventory reflects the oldest, and often lowest, purchase prices. In a period of rising prices, LIFO produces the highest COGS, the lowest net income, and therefore the lowest tax bill. This is the primary reason companies adopt LIFO, tax savings. However, the balance sheet inventory figure can become severely outdated, sometimes reflecting prices from decades ago. Weighted average, a single average cost per unit, is calculated for the entire pool of goods available for sale, and that average is applied to both COGS and ending inventory. Results fall between FIFO and LIFO. This method smooths out price fluctuations and is simpler to administer. Consider a practical example comparing cost flow methods using identical data. In our bakery scenario, 200 units are available while 100 are sold amid rising prices. Tables detail how FIFO yields lower cost of goods sold with higher ending inventory, whereas LIFO shows opposite effects. Weighted average strikes a balance between the two. Note that weighted average cost equals $2,440 divided by 200 equals $12.20. Cost of goods sold equals 100 times $12.20 equals $1,220. Now we connect the big picture in cost accounting. 4 key questions outline our exploration: accumulating costs, allocating overhead, assigning costs to inventory, and determining cost flow out of inventory. The first decision is how to collect costs. In job order costing, costs are accumulated by individual job, batch, or project. Each job has its own cost sheet tracking DM, DL, and applied OH. This system is used when products are unique or customized. Think custom homes, audit engagements, movie productions, or specialized machinery. Once you decide to include overhead in product costs, as absorption costing requires, the next question is how to allocate that overhead to individual products. Given that costs have been accumulated, layer 1, and overhead has been allocated, layer 2, the question becomes, which of these accumulated, allocated costs actually belong in inventory? Absorption says all manufacturing costs. Variable says only variable manufacturing costs. Throughput says only direct materials. The rest of this handout and today's lecture explores this question in depth. Finally, once costs are in inventory, FIFO, LIFO, or weighted average determines which unit's cost goes to COGS when a sale occurs. Now we shift focus to manufacturing cost allocation, absorption, variable, and throughput costing. This slide poses a critical question: which manufacturing costs belong in inventory? Notice the clear layout, with an icon of interlocking gears, bold headline, and a highlighted statement warning that the answer influences reported income and managerial behavior. It challenges you to consider how cost allocation affects production decisions and financial outcomes. Explore cost impacts on overall business strategy now. Let's dive deeper into manufacturing cost components. This slide breaks down direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Everyone agrees that DM, DL, and variable manufacturing overhead are product costs. The disagreement centers on fixed manufacturing overhead. Is it a cost of making the product, or a cost of having capacity available? Your answer determines which costing system you use. Absorption costing, known as full costing, distinguishes between inventoried product costs, which include direct materials, direct labor, variable and fixed manufacturing overhead, and period costs like selling and administrative expenses. An absorption income statement format demonstrates gross profit calculation. The separation into blue and red categories clarifies how costs are treated, reinforcing GAAP and IFRS standards, and emphasizes the importance of aligning cost allocation with accounting principles. Variable costing, or direct costing, is presented on this slide with clarity and precision. The approach divides costs into inventoried product costs, direct materials, direct labor, variable manufacturing overhead, and expense period costs, including fixed manufacturing overhead and operating expenses. An income statement illustrates contribution margin, calculated by subtracting variable costs from revenue then deducting fixed expenses. This method, designed for internal analysis, offers insightful contrasts to absorption costing for clarity. Throughput costing, or supervariable costing, is explored next with emphasis on theory of constraints. Only direct materials are inventoried, while direct labor and all overhead become period costs. The slide contrasts inventoried expenses in an orange box with expense costs in red. An income statement format calculates throughput margin by subtracting only direct materials costs from revenue. This method sharpens focus on variable costs and challenges traditional cost allocation practices. The rationale goes further than variable costing. In many modern manufacturing environments, labor is a committed cost. You pay your workers whether the line runs or not. If DL does not truly vary with short-run production volume, it should not be inventoried. Throughput costing is the accounting system built for the theory of constraints, developed by Eli Goldratt in his 1984 book The Goal. The core idea is simple but powerful. Every system has at least one constraint, a bottleneck, that limits total output. Optimizing anything other than the bottleneck is waste. It just creates work-in-process inventory that piles up in front of the constraint. The slide outlines 5 focusing steps, from identifying and exploiting the constraint to elevating capacity, and then repeating the process to find new constraints. Additionally, the throughput formula, revenue minus direct materials costs, helps managers concentrate on the true drivers of production efficiency to improve overall performance. Strips everything except DM, then divides throughput margin by bottleneck minutes to get the only metric that matters: cash generated per minute of the constraint. This slide offers a clear comparison of 3 costing methods: absorption, variable, and throughput, showing how each method treats cost components such as direct materials, direct labor, and manufacturing overhead. Moving from left to right, fewer costs are inventoried. This means less cost sits on the balance sheet as an asset, and more cost hits the income statement immediately. When production exceeds sales, absorption costing defers the most cost to future periods, resulting in the highest reported income, while throughput costing defers the least, resulting in the lowest reported income. This slide compares revenue, costs, margins, and net income under absorption, variable, and throughput costing methods. The example details production and sales data, highlighting how unsold inventory and fixed overhead allocation influence net income differently. The $12,000 gap between absorption and variable NI equals exactly the fixed MOH deferred. 2,000 units times $6 per unit equals $12,000. The $26,000 gap between variable and throughput NI reflects the DL and variable MOH also deferred under variable costing. 2,000 units times $8 plus $5 equals $26,000. More cost in ending inventory equals less expense on the income statement equals higher reported profit. Absorption defers the most, throughput defers the least. Over the full life of the company, total income is identical under all three methods. The differences are purely about timing. Exploring the overproduction problem. This slide explains how absorption costing can temporarily inflate profits when production exceeds demand. Because absorption costing allocates fixed MOH to each unit produced, a manager evaluated on net income has an incentive to overproduce. Here is how it works. 1. Demand is 10,000 units, but the manager orders production of 15,000 units. 2. Fixed MOH of $60,000 is now spread over 15,000 units equals $4 per unit instead of $6 per unit. 3. COGS for the 10,000 units sold includes only $40,000 of fixed MOH, 10,000 times $4. 4. The remaining $20,000 of fixed MOH, 5,000 unsold units times $4, is deferred in ending inventory on the balance sheet. 5. Reported income rises by $20,000, with no increase in revenue, no improvement in efficiency, no additional customer value. This slide reconciles absorption and variable income by comparing scenarios where production exceeds, falls below, or equals sales. An equation links the difference in net income to changes in inventory levels, highlighting fixed overhead's role. Over time, total income remains equal, with only timing differences separating the methods for financial reporting. A common student question. If GAAP requires absorption costing but managers need variable costing, do companies maintain two separate accounting systems? The answer is no. Most companies maintain one primary accounting system, built on absorption costing, because that is what is required for external financial statements and tax returns. The General Ledger and ERP system, SAP, Oracle, etc., record all costs at the transaction level, tracking direct materials, direct labor, variable overhead, and fixed overhead in separate cost pools. This granularity is essential. To produce variable costing reports for internal use, the cost accountant performs a simple conversion at the end of each reporting period. For throughput costing, the conversion removes both fixed MOH and conversion costs, DL plus variable MOH, from the inventory change. This slide details how companies use three costing views for varied purposes. As a cost accountant, you do not pick one method and ignore the rest. You need all three. The question is which system fits which purpose. If the audience is external stakeholders, SEC, IRS, banks, auditors, use absorption. You have no choice. GAAP and IRS require it. If internal managers are making operating decisions, pricing, make or buy, evaluating segments, use variable. Income tracks sales, not production. No overproduction incentive. If the operations team is managing bottlenecks and capacity, use throughput. Focuses on the constraint. Maximizes throughput per scarce resource. This instructional slide explains the process for converting between costing methods. On the left, steps to change from absorption to variable costing are outlined, including identifying fixed MOH per unit and computing deferred costs. On the right, a similar method adjusts for throughput costing by removing labor and variable expenses. A concise formula paired with a numerical example reinforces how these conversions support accurate internal reporting, ensuring clear financial insights and consistent accuracy. This slide presents the larger context behind absorption and variable costing. 4 color-coded sections deliver key messages. Managers may manipulate earnings with absorption costing. Variable costing offers clearer decision signals, and adjusting financial analysis is vital. Also, inventory choices impact both the balance sheet and income statement. The concluding quote reminds us that understanding both methods, like a pilot bracing for weather changes, is crucial for sound financial judgment and strategy in practice. In this final summary slide, 5 key bullet points articulate the fundamentals of inventory costing. The points explain how absorption, variable, and throughput costing affect income and inventory valuation. It highlights that businesses maintain one set of books required by GAAP, while making internal adjustments for decision-making. An icon of scales of justice reinforces fairness in accounting, and course details remind students of ACCT 338 at Carson College of Business, summarizing the session.